Welcome to the Transparent FX Academy. In this tutorial, I will be speaking about a very important topic. So make sure that you stick throughout the video without skipping any part, because this will be a very important video. So without further ado, let's jump straight into it. This will be a very important tutorial because I'll speak about what are the major mistakes that traders make. And for sure, you're making some of these because all traders, whether they're just starting out or already have trading experience, usually are making at least a few of these, and it's really impacting your trading in a negative way. So as usual, I will be as clear as possible. We will proceed in order and I will expand on each and every one of these major categories of mistakes. The first one that I have here already here written for me, just so I can remind myself of speaking about all the different aspects of these mistakes, is the discretionary aspect that most people are having with their trading. So they don't really have a clear set of rules that they're following. And what do I say when I speak about clear set of rules? A set of rules that even a machine could execute. Now, if you're trading and, for example, you have a strategy which is based on, buying and selling at previous resistance turned support areas. So, for example, you have this area here. This is a previous level of daily resistance. The market then breaks it to the upside. At that point, it becomes support. And your strategy is usually buying manually when a market is retesting previous resistance turn support. Maybe you are combining that with some order flow analysis, but you really don't have a clear set of rules on how much you're risking per trade. Where does your stop loss go? Where does your take profit go? Because if you really had a clear set of rules, those rules could be coded. They could be coded into an EA. You could use MQL4 or MQL5 as programming language directly from your MT4 or MT5. And you could backtest that strategy using the MetaTrader backtester on years and years and years of historical data. So you would essentially have precisely your backtesting results for that particular strategy. Instead, most people are just trading manually, because one of the other advantages is that once you have programmed your EA, so your strategy is already written in code, then you can execute that strategy in a completely automated way and even build a portfolio of strategies, which would be impossible if you're trading manually. If you are behind the charts all the time, it would be impossible to execute many strategies across many markets, possibly uncorrelated strategies. That would be very, very, very difficult, and actually would be pretty much impossible, because an EA can trade for you 24/7 your strategy, while you will need to sleep, you will need to do other things, because obviously you have a life, you're not just a program executing. So that is the first major aspect, the fact that you are trading discretionary. And there is also another aspect to that, which is that you have the emotional side of trading, because even though you could execute a strategy that could be executed by an EA manually, anyway, if you're doing it manually, there is an increased probability that you will be making mistakes, because you will have the emotional side of trading. So you might close the trade early, you might not place the stop loss correctly, you might risk more, you might risk less, and anyway, you will temper with the overall performance of that strategy from a backtesting perspective. So if the same strategy was backtested in a specific way, the probabilities of you trading that strategy during the backtesting period from a hypothetical perspective, there would be a very high probability that anyway those would have not been your results, because during that trading you would make mistakes, both psychological, emotional, And you know that already, because for sure you have done that already. It happened already in your trading that you knew what you were supposed to do, but then you did a completely different thing because you got emotional. And then looking back, you notice that, okay, I did not actually follow my trading plan and my strategy on that particular trade. And if you're journaling, I'm sure you have noticed that already. And that gets completely fixed if you have a rule-based strategy, which can be coded and executed in a completely automated way. And if you have a strategy which really is rule-based, it's almost for sure that you can actually code it into an automated EA. The second major mistake that most traders are making is mistakes with their stop loss. Now, let's elaborate on that. What do I mean when I say mistakes with stop loss as well? Mainly, I'm speaking about three things. First one, people are placing their stop losses too close to the entry price because what they're aiming for is the highest risk to reward possible. But I'm sure that it has happened to you many, many times that maybe you were looking to short a specific market. And let's say, for example, you were looking to short here, you had your stop loss too close because you were really lured into the very high risk to reward, looking at like, okay, I have now here a 1 to 6 or a 1 to 7, a 1 to 8, let me tighten my stop loss even more. But then what happened is that the market hit your stop loss, and only at that point started moving in your direction, and maybe the trade even played out. I'm sure this has happened to you many, many times. So even when developing strategies, make sure that your stop loss has enough room. You need to leave some room for a volatility of the market, because markets are volatile. You need to let the market have some breathing room. So even though the trade might go not in your favor, so against you for just a small period of time, anyway, you need to give the possibility for the market to reverse back to your overall direction, because markets are volatile and you need to give enough a breathing room to your trade and not look to just have the tightest stop loss possible just because you're lured into the possibility of having a very, very high risk to reward. The second one is moving your stop loss once the trade is already opened. I'm sure that many people do that. And again, this a bit goes back to the initial point of the discretionary aspect that many people have in their trading. If you're moving your stop loss, you're messing with your risk management. That is something that you should never do. If you have a clear strategy, the stop loss is supposed to be there. Whether you're trading it manually or your EA is trading it, anyway, you should leave your stop loss where it is at the beginning of the trade, unless the strategy specifically has a trailing stop loss. But all of that should already be decided before the trade is even executed. And the third major mistake that many people have is they are just using fixed lot sizes. Now, I don't really recommend that. I recommend that when you're looking to trade, you already know in advance your risk per trade. So let's say I'm looking to short here your USD. I should calculate my lot size so that this distance here from the entry to my stop loss is the percentage that I already wanted to risk at the beginning. Let's say, for example, 1% risk per trade. My lot size should be dynamic, so should be adjusted so that if the market actually hits my stop loss, then it essentially should be a 1% risk or a 2% risk or a 3% risk. You should know that already from the start. So again, even this ties back to the non-discretionary aspect that your trading should have. And unfortunately, most people are trading in a discretionary manner. The third thing that I want to speak about is not using fundamentals. Now, I'm not speaking only about fundamental analysis. You know my take on fundamental analysis. I think that when it comes to fundamentals, the easiest way is looking at the non-commercials when it comes to the commitment of traders, because hedge funds and anyway speculators, big institutional speculators that are in the market to make money, they are following the fundamentals better than you as a small retail trader could ever do. And so what I think is that looking at their positioning and how it's changing is a good overall view of how the biggest institutions in the market are viewing the fundamentals. So it is like a proxy for the overall fundamentals of the market, in my opinion. And that is why I like the COT data that much. But I'm not only speaking about people not looking at the COT data as a mistake or people not looking at fundamentals. Even if you have a strategy which is not based on the COT data or the fundamentals, anyway, what I think is that it should have some fundamental aspect to it. Let's say, for example, you are looking at breakouts during the start of the most liquid sessions. So the London session, the New York session, that is a strategy that has a fundamental aspect in it, because it is true that the volume and liquidity in the market increases during those sessions. So there is a fundamental aspect to that strategy. So it is a strategy that makes sense. And most strategies that are just like, there are some strategies that I've seen from people that really don't have any intrinsic fundamentals to them. I think that is a mistake. Most strategies should make sense, should have some aspect to it that is fundamental to the structure of the market itself, and that makes sense, if you understand what I'm saying here. The fourth major mistake is capital. And I'm not only speaking about like having too little capital or too much capital that gets you emotional. What I'm speaking about is your approach to the capital that you're trading, because I noticed that most people will trade in a completely different way, depending on whether or not they have a small pool of capital or a big one in their trading account. And that really shouldn't change. The way you're trading a $100,000 account, 1 million or 10,000, it shouldn't really change. The trading in general should all be played out in the same way based on percentages, in my opinion. So the portfolio of strategies that you're running on an account, and I speak about this a lot, I think that the best way is having a diversified pool of strategies running on the account on different markets, possibly uncorrelated strategies, and everything should be based on percentages. That is in my opinion the best approach to having a trading portfolio, and many people agree with me on that. My opinion is that, and actually what I have noticed is that most people will take excessive risks when they have a small account and will start to have a lot of emotional aspects with a big account, while the solution to that would be to always have a really rule-based approach, whether or not there is a small account or a big account, and the percentages from a strategy perspective should remain constant, whether or not the account is small or big. Now, all this free education and analysis that you see me share here on YouTube is actually just the tip of the iceberg. In fact, if you want to learn more, I really suggest that you go over to the Transparent FX Trading website, which you find linked in the description. And here you will have the possibility to gain access to all my courses, which range from the very basics of trading to the more advanced topics like building automated trading systems, building a portfolio of strategies, uncorrelated strategies, and much more, using quantitative finance tools like the Quant Analyzer. So it's really something that you cannot afford to miss. You also have the possibility to gain access to my trading station software with the Telegram notifications integrations, one-on-one mentoring directly with me for any questions you have along the way, the COT data software, which you often see me use here on my YouTube videos. The program is also an all-in-one program, so you gain access to everything immediately, including all my strategies and EAs, and you also gain access to my entertaining trading show in which I share all my trades as they're happening. Here, you will see the presentation of each and every one of my strategies with the full historical backtest and presentations of the rules of the strategy. You also, as we were speaking about, have access to the live trading show. So essentially, every trade that is taken on my live account is automatically shown here in a very entertaining fashion as they're happening. So opened, closed, managed, so you can learn even more. And as you scroll down, you will see that you have the possibility to join and gain automatically access with the email and password that you will create during the registration process. So again, I really suggest you go and check it out. The link is in the description, and I will see you on your student dashboard. If you enjoyed the tutorial, make sure that you click on the like button to support the channel. Also, let me know in the comments below if there are any new topics that you would like me to cover in my next videos. Also, subscribe to the channel so you never miss new updates, and I will see you in my next tutorial.